Welcome to this lesson where we will discuss the development of financial accounting and reporting standards. Today we'll discuss the generally accepted accounting principles, otherwise known as GAAP, their purpose, and the organizations responsible for setting those standards. So first we'll start with, what is GAAP? Well, before we start with that, we should just take a quick reminder what the objective of financial reporting is, which is to provide useful financial information to investors and creditors. So GAAP, the generally accepted accounting principles, consists of standardized accounting rules that ensure consistency in financial reporting. So I'll repeat that. There's standardized accounting rules that ensure consistency in financial reporting. Their primary objective of financial reporting is to provide the information to investors and creditors to help them make informed decisions, because those groups rely on the financial statements to assess the company's performance and making decisions based on those financial statements. If we don't have those uniform accounting standards, each company would be able to apply different rules, and therefore investors and creditors would not be able to compare financial statements. They wouldn't be able to do an apples-to-apples comparison. So what GAAP does is it establishes broad and specific guidelines to address how transactions should be measured, recorded, and reported in their financial statements, as well as what notes need to be included in the financial statements to give further insight into what it's reported on their financial statements. It dictates whether the assets should be recorded at historical cost or fair value, where the transactions should be presented in the financial reports, and what additional disclosures should be included. So next is, well, we have these GAAP rules, and who sets them? Let's go next. So the establishments of accounting standards is theoretically within the purview of Congress. However, Congress has really delegated this authority to the SEC and to the private sector. The SEC, which stands for Securities Exchange Commission, plays a very important role in overseeing financial markets, and which ensures a transparency in financial reporting. Just to give a little history lesson, the SEC was formed following the stock market crash back in 1929, which exposed a lack of reliable financial information for investors, because many individuals invested in companies that either were fraudulent and didn't actually exist, or misrepresenting their financial health by inflating their numbers to make themselves look better. So in order to restore the investor confidence, Congress created the SEC to regulate disclosures and reporting requirements. There are two key laws with the SEC put into place. The first one, the 1933 Securities Act, which applies to initial offerings. It applies to initial public offerings, which are otherwise known as IPOs, and they require companies to provide accurate and complete financial information when they first sell their stocks or bonds to the public. So this is when a private company goes public and can be part of the stock exchange and anyone can buy stock in it. That's the IPO, and this is the law that applies to them. Once the company is public, it falls into this 1934 Securities Exchange Act, which applies to secondary market transactions, which means after the IPO. And what this act does is it sets the rules for reporting requirements for companies that are publicly traded, such as the 10K and the 10Q. So just really a quick historical lesson of how things came about. The standard setting responsibilities, they have evolved over time, beginning with this committee called the Committee on Accounting Procedure, otherwise known as CAP, which was part of the American Institute of Accountants, AIA, and that eventually the AIA became the American Institute of Certified Public Accountants, the AICPA. The AICPA, sorry, not the AICPA, CAP, this right here, issued accounting research bulletins on a case-by-case basis, but they did lack a comprehensive framework for setting those rules or those standards. And it was a piecemeal approach in that as issues came up, they would issue research bulletins, and the reactive approach was really not quick enough or adequate enough for maintaining consistency in the financial reporting, which led for it to be replaced by the Accounting Principle Boards, APB. The APB had introduced formal opinions on accounting matters and was primarily composed of CPAs who volunteered their time. They did face several criticisms for favoring accounting firms and excluding other stakeholders such as like government representatives, educators, and analysts. And it also lacked a theoretical foundation for establishing any accounting changes. So to address these shortcomings, the APB was replaced by the Financial Accounting Standards Board, which is right here, the FASB, which still exists today. So in response to those past criticisms, the FASB was established to represent not just accounting firms, but all the various groups that rely on financial reporting information, financial statements, such as auditors, businesses that are profit-oriented businesses, educators, financial analysts, even government entities. And so that would ensure that accounting standards address the needs of everyone, not just public accounting firms. The FASB is made up of 7 full-time members who oversee all the standard setting processes while balancing the interest of the different stakeholders. And it operates under the oversight of Financial Accounting Foundation, FAF. Now, there would be various issues that came up very quickly that needed to be addressed. And so in order to address any sort of emerging issues quickly, a task force was created called the Emerging Issues Task Force, and that was formed in 1984. So one of the main criticisms of the previous accounting standard bodies was that their slow response to changes. Therefore, this EITF helps bridge the gap by offering guidance on implementation, and they resolve urgent accounting matters. They do not set the rules or the law, they just give guidance. When a new financial matter arises, the EITF will provide the preliminary rulings to guide businesses until the FASB has a chance to formally issue a standard. Once the FASB issues a standard and is ratified, then it becomes part of US GAAP. So this is just a quick check. Accounting standards in the United States are currently set by the FASB. And you'll hear that throughout the course of this entire course and when you work in any sort of accounting job. Let's go here. So FASB issues their official standards whenever they issue a new rule, if you will, any new standard, it's called an accounting standard update, or otherwise known as an ASU. When they're finalized, these updates clarify any financial reporting information. In 2009, the FASB compiled historical accounting standards from such as the opinions, the research bulletins, and the ASUs into what's called the Accounting Standards Codification, ASC, Accounting Standards Codification, which puts all those accounting standards that I listed, the opinions, the research bulletins, and ASUs, into a structured, searchable online database that makes it easier for anyone who needs to access it to be able to navigate through it. And you can find it on the FASB website. The ASC, the Accounting Standards Codification, includes all the relevant SEC guidance, which applies to public companies, and organizes into main topics, including these ones listed here, such as the general principles, presentations, every section of the financial balance sheet and income statement, broad transactions, and industry-specific standards. And each category contains subtopics for more specific guidance. And just so you know, to understanding how to research and reference the Accounting Standards Codification is really essential for anyone who's taking the CPA exam, as there are often they test simulation in the CPA exam using these codifications. So we've discussed everything that's happened in the US historically and how the accounting standards boards have come about. So now we're going to shift our focus a little bit to the international standard setting, which is put on by the International Accounting Standards Committee that was formed in 1973 to establish global accounting standards, uniform global accounting standards. And the new standard setting body is called the International Accounting Standards Board, the AISB, which is equivalent to the US Financial Accounting Standards Board, also known as FASB. And so the AISB, they develop the global accounting standards, and they issue their own standards, just like we issue our own standard called Accounting Standards Updates, the ASUs. The AISB develop what's called the International Financial Reporting Standards, IFRS. So this slide just kind of gives a comparison of US GAAP to IFRS and who oversights their accounting boards and who they are. So here, when we look at the standard, when we look at the comparison between US GAAP and IFRS, this slide just shows us who is responsible for different issues. And you can see here under the standard setting board, the FASB is responsible for setting the accounting standards for US GAAP, and the ISB is responsible for setting the International Financial Reporting Standards, otherwise known as IFRS. So the IFRS was established basically in 2001, and they are a global set of financial reporting standards. And now, over time, it was established in 2001, and over time, more and more countries are basing their accounting standards based on IFRS rather than their own individual country accounting standards. And by 2024, there's over 120 jurisdictions that have adopted the use of IFRS. Now, what would be nice is if the US GAAP and IFRS kind of merged into one global, if you will, international standard that's to be used in the US and everywhere else. And the FASB and ISB have been working many years to make that happen. However, it doesn't look like it will be achieved anytime in the near future. It becomes a problem when you have a company that has multinational entities. So I worked at Allergan before it was acquired, which was a Fortune 500 company, and we had offices and operations all over the world, and we had to report worldwide figures on our financial on our 10K, and it became more complicated because different countries that we were in adopted IFRS, and then they would have to almost keep a separate set of books under US GAAP, because when we reported on the 10K, we report under the US GAAP rules, not IFRS. So it becomes a lot more work for companies, because many times, they have to maintain two different sets of books. Now, throughout this course, and if you're planning to take Intermediate Accounting 2 course, IFRS comes up all the time. We will learn about the US GAAP rules, but then there's always a section about here's how IFRS is different than the US GAAP, because in the real world, you'll probably have to know at least some of those rules.